Welcome back to the YouTube channel. I'm Adam Adams, and today's video, we had a recording. So I went to lunch with about 50 of my friends, and what we were talking about, we spent about an hour really diving into market selection. So it was just Q&A with all 50 of us and anybody who was actually investing in either large apartments or small houses in all these different markets were adding value. So I'm going to get you into the video, but before we do, I just want to say, will you do me a favor? Will you like, comment, subscribe underneath? Just help me out. Like, comment, subscribe. Anyway, here's the video. Cool. All right, so let's get into the mastermind. Today, I want to talk about market selection. So with market selection, there's a lot of things involved. So make sure that you write down any questions that you have. Oh, I need to tell you. Flip over the mastermind thing. I saw the back of yours and you helped me remember this. So just if you know you want to do it, then just fill that out. I'm not asking for your credit card number. What I'll do is I'll send you a PayPal invoice, and as long as you pay the PayPal invoice within a few days, you'll get it at that price. So yeah, if you want it, just fill it out and give it to me. And thank you. Thanks for showing me the back. All right, so there's a lot of different parts to actually analyzing a market, one that you're going to want to be involved in. You have to think about things like how many people live in that city, what is the MSA, which is the market around it, how big is that? You want to think of things like what is the job diversification in that area, and many, many, many other things. You want to be looking ahead for years and for several years before you get into a market. So what we'll do is we'll basically just pass this mic around to anybody who has a question. And I made sure that Nanny and Brad were here because they work in acquisitions with our company, so they do a lot of this research. So if I can't answer it, hopefully they can, and if we can't, hopefully somebody in here will be willing to offer the advice. So who wants to take the mic first? It looked like you wanted it. Do you want it? I want it, yeah. Okay. Who wants to take the mic first? Does anyone have a question? Okay. You and you.
Well, I'm interested in investing out of state, primarily Ohio and Florida, but also heard of Indiana and Illinois. But for someone who doesn't know where to start, what are some tips of, how to pick some areas to go and research?
Okay, first off, you have investments in Ohio. Raise your hands if you have investments in Illinois, Indiana, Florida. Okay. All right, so perfect. What your question is what are some things to consider before you get into these markets? Okay. Who wants to take it?
I'll take it first. One of the things I like to do first is I definitely like to talk to brokers, commercial brokers or residential brokers. So if it's commercial, I'll get on LoopNet. I'll see what people specialize. I'll see, how many deals they've done, what kind of listings. And then I like to just, pick their brain on certain areas, that are up and coming. And then, I might get my feet wet, jump on some websites. There's one in particular that I'd like to get on. It's called niche.com. And it just kind of highlights the area, what the median income is, potential rent growths, the amenities, those type of things. You can get a really good feel for a certain locale, even in a certain city or wherever you're looking for. But I like to build my power team. I like to have lenders. I like to see what they think about the area, what rates are like. So that's kind of where I like to start.
Could you spell niche? Is it N-I-C-H-E?
Yep, just like that.
So one thing I'll say as well is It depends on what you mean by a good market. If you have the ability to close on the property yourself, then that's something you can define for yourself. If not, if you're working with sponsorship, then they're going to determine that. They work in specific markets, and you're better off looking for deals that they want to close on in a certain market. So, each market has positives and negatives, but, saying what is a good market is pretty vague. You've got to really hone in on what's important to you or your investors. Once you know that criteria, then you can start looking.
I'd like to dovetail off of Brad there that having a team is important. I think when I first got into multifamily, we had some assets that we could put our own money into deals, and it sort of limited us in how we could get a bigger picture, if you will. So having a team is important, and you hit the point there is that you need to know your team's strength. And what I mean by that is if you have somebody who's going to be the credit on the deal, somebody who's going to sign on the loan documents, you have to understand them and their comfort level, and maybe they have some experience in certain markets that hit their side, or that hit their fancy, for lack of better words. But as these guys, BlueSpruce, they put their team together so they understand it. And then the other side is kind of putting my lender hat on. I get a lot of questions from investors saying, well, does this size well? Does this property, should I buy this property? And I tell them back to the same thing. Have you looked at your investors' needs and what they want? Because the deal in the markets, again, should be sized on what your investors' capability is and what they're looking for. I've learned from a lot of different syndicators out. One of them's Anthony Char. He would always say, you never give up what you want your investors to ask. You ask them what they want. And a lot of times you'll find that your investors, they may not want as much as you think that you would have to put the numbers at. So that can help you. And if you're doing a syndication, you have not only your investors that you have to pay off, but you also have your syndication team. So you might have an asset manager. You might have the experience partner. You might have the credit sponsor. So I have a lot of guys who fail in their sizings. They're like, great, I got this is an 8 or a 9% cash on cash return. Is this a good deal? I'm like, well, if your investors are looking for 8 or 9%, how are you going to pay your team if you're syndicating the deal? And so you have to look into those things. So having a team and being able to let yourself go in certain areas. I always tell people, let your pride go, let some of you go. Where you're strong at on that team, do what you do best and find somebody who's strong in the other areas. If you have somebody who knows how to look at crime reports, or somebody who can investigate an area and knows how to follow realtors, let that person do that part. If you're good at raising money, you be the guy on the team that raises the capital. If you're good at spreadsheets, you're the guy that maybe does the analysis. So find your strengths and let your weaknesses be known sooner than later. And I just think that the team concept is where you're going to get a lot of deals done in the syndication. If you got buckets of money and big bank accounts, you can maybe just do it on your own. But I think syndication is a way to mitigate your own cash and use other people's money. So get a good team.
Excuse me, what's your typical rate of return for the passive investment?
I don't think we could really talk about rates of returns, right?
Is it 8% or is it too much?
Well, I guess I could say on a deal that's close. Again, it depends on your. I've seen it all over the place. I asked a lady who felt confident in our process, and she was wanting to put tons of money into our deals, and she said, "Wow, you guys are doing a good job, and I like my returns. I'm doing this," and we just asked her early on, what do you want? What's happy for you? You know what she told us first off? No, she said, I'm making 0.05% in my money market account at the bank. And I'm making maybe a 5% return on mutual funds. So do you think you can give me 6%? So that's back to the point of asking and seeing where, and you have some guys that want 8 or 9 or whatever they want, and then you build off of that, right? And you size the deals based on that investment. So a lot of students, if they're putting their quick analysis together, they put their numbers like, I hit this number, and like we do cap rate, and loan to value, and all those things are important. Debt service is important. All those numbers are important. But the biggest piece is if you're syndicating the deals, you got to get paid too. You can't work for $3.50 an hour. So you have to learn how to size your deals, and when you get more better at that, it's easier for you to shoot. And don't be afraid, guys. When you have a deal, even if you felt like the size and like this is what I'm going to go, stick an LOI out there. Don't be afraid to get the LOI to those realtors. The more often you do that, the more chances you got at somebody actually saying, "Hey, we want to talk to you." Even if you think if the deal was, it's sizing at a $2 million purchase, and you come in and say, "We think it only sizes at $1 million." You might feel like you're insulting them, but at least let them know that, hey, we think you might be insulted by this, but here's what our sizing did. What do you think? And you'll be surprised how many times those deals. I think somebody was saying over here earlier that those deals will come back to you if you're persistent with realtors. So that's my tip of that is be persistent in your approach. But again, back to my first point, having a good team is important. I couldn't do it by myself. I have a great team behind me. BlueSpruce has an amazing team. Meet guys like that. Team up with guys like that. It'll help grow your business.
Yeah. I think. You want to take that?
Maybe a little.
One thing about going out of state and learning those things is go where you're comfortable. If you have friends or family in those areas, make it a dual trip, and then they can help you connect. We know I own I-Corp, Investment Community of the Rockies, is part of the National RIA. Organize a meeting, you organize your trip around a national RIA meeting there, so you get to find something. Go on the internet, look up events like this, go to one of these events. And this is where the people are. And this event is going on probably 50 different places throughout the country right now. All right? So go find the people that are actually doing business. Don't necessarily take the first Google realtor out of there because you don't know if that realtor is actually doing any business. Go find investment-friendly people. And as John was talking about building your team, investment-friendly is such a key to this business that you can find people that talk a big game and they act like they have a lot of information, but they don't. So go find investor-friendly people because then you can find the investor-friendly contractors and you find the investor-friendly property managers. Because people who understand investors understand that we're not in it for the short term. We're in it for the long haul, and we will buy over and over and over again. These short-sighted, people who are in the one-off flipping houses or one-off, working with a residential person, they get to do a house once. And then they're not going to hear from that person for 10 years. If they do a good job with a flipper or somebody in this business or multifamily, they're going to see us over and over again. The other little tip I'll give you, find some place you can get to in a plane ride and not have to drive 3 days or 3 hours or 4 hours. I learned that lesson going to Peoria, Illinois, and trying to find property there. My flight got canceled. We had to fly out of St. Louis, but it still took us a day to get there. Find someplace easy to get to so that you know how to get there. You don't waste a day of travel on both sides. It's time. Like Adam says, time is so valuable. A day in the airport and 3 hours in a rental car wastes a lot of time. So those are my 6 cents.
What other questions do we have? Kathy has one. Oh, good.
So, what advice would you give if I'm looking at a market that's less? It's a smaller market, like less than 20,000 people, maybe, or what's the rule of thumb when analyzing a small market like that?
Good question. Does anybody have an answer to that? What happens when you are looking at a market with less than 20,000 people? You want to look at it?
Hey, Kathy. So we did a deal in Branson, and usually our criteria is over 20,000, but it was a little under. And one of the things that I like to know is what's the economy like there? What's the job market like there? Once you understand what's happening and if there's any potential development, what the job growth, potential rent growth might be, I think that may help you out. I would definitely speak to somebody at economic development to see what's on the forefront as far as what's happening now, 1 year, 3 year, 5 year, maybe even longer if you can figure that out. So I would definitely plan on talking with them as a start.
Another response to small markets?
The economy is key, and you got to look at what the grounding factor is. Is it development? Is it oil?
Military.
Steel? If it's military, sure, but we've got a pro-military president in place. But what happens on the next cycle? And he decides to close down. So you got to kind of weigh those issues. Is there something to back it up? If he pulls out, and that base closes, I mean, you got a piece of unfortunately worthless property. You really got to be careful or have a better exit strategy to what's going on. Politics, like Mandy said, about the economic development, every small community, every government office will talk to you and tell you everything they've got going on. In fact, ask them what kind of incentives they have. Do they have incentives for you? Can you get some development stuff out of them? They may have money. They may have special districts that they want you to come in and fix. And you could go that way as well. So calling those government offices, I met with a bunch of people in Peoria, Illinois, trying to figure out if I was going to invest that. If it wasn't in Illinois and didn't have such high taxes, and half the community wasn't underwater and they weren't selling properties at $500 a piece, we probably would have invested them. But that's the type of question you ask. That's the type of question you need to know. And locals are the best way to do it.
Question would be, how do you find local investor-friendly contractors that can get the job done timely and correctly so that you can get the property rented?
Talk to me.
Do you fly?
I do travel and I kind of commercial voice.
For the right price.
Adam knows I'm very, very much open to doing value adds and traveling for them also.
Adam's a king of meetup. That's one way to find it.
I was just going to say that.
I know someone named Tim Emery. He's part of National RIA. That might help.
Basically, piggyback off what Tim said, get on your meetup.com, check out the national RIAs, attend those RIAs, and find out the investor relations, your investor brokers, investor lenders, things that he was saying.
Your real estate investor group, it's real estate.
I've got a friend that just goes to the bar and asks everybody. And he's done really well.
I would also say Facebook groups are really prominent and becoming more and more prominent as time goes on. So if you're, as many of us know, we're not going to give up a good contractor, but occasionally you will get one. It's the most unanswered question on the internet is who's a good contractor you recommend? Because nobody wants to give them up and make them too busy. But if you find local Facebook groups or other things that are associated with investors in those areas, you can ask specifically through those groups, and it's pretty easy to get in for the most part.
Bigger pockets.
Yep.
Dan's part of Bigger Pockets. I mean, I use Bigger Pockets all the time for that. So, that's where you find those local investors. And one thing that you got to know, though, is you're just not going to find local investors. You got to ask them the right questions. You got to know what you want to know. You can't let them tell you. You ask them the right questions and listen to their answers. All right? I get it. Adam was talking about we get a lot of calls from people who want to take our time and listen to us. Well, ask us questions and we'll answer them. Right? If you spend all the time telling me what you want, and you waste half an hour of my time telling me what you want, that doesn't do us any good. Ask us questions so you can hear. And as you get more experience, you'll be able to hear those lessons, and you'll be able to hear what realtors or what property managers or what those types of people are going to give you in response. And that's the good part of listening to these people. And guys, at these types of events, if you're new, if you're brand new, and I tell this to a lot of people, listen to the people that are experienced in these rooms. All right? Don't stand there in front of the room with me and talk to me about you. No offense, I don't really care that much about you. You're looking to gain knowledge from me. Adam has this, Manny has this. You're looking for that's one of the keys to this business.
Where's the mic? Oh, I'll bring it to you.
There was a question on the small markets. My group, when we look for the small markets, one of the first questions we ask is there enough property management companies in the area? I guess this is our style. Some like to manage their own apartment complexes, but we prefer to have third-party property management. And from the lending side, that's going to be required in a lot of smaller town or out-of-town type transactions. If you live here in Denver, most all the lenders I work with are going to require you have third-party property management unless you have a good portfolio out there already and you're maybe doing some self-management and can prove that to them. So we always look at that first as finding property management companies. If there's only one in the neighborhood, that's probably not good. If there's two or three, then you have some opportunities to look at those. And so with that same question, the property management companies are a great resource as well. A lot of times they're the ones that are responsible for getting out somebody to do some work. If maybe there was a tornado that blew some roofs off or something, the first person that's going to be the first line of defense to that is going to be the property management company. And they're going to make sure that they get that out there. So they may already have some contractors and people in the area that can work on. So looking for property management companies to help vet out some of that information is crucial because they're the ones that are operating and they know a lot about the market because they're the ones that are trying to keep and sustain the tenant base. So they have a lot of know-how and know the community in those small areas. And that's the hard thing is sometimes in those smaller, less than 20,000 MSAs, you don't find as many property management companies. So sometimes, for us at least, it wouldn't be necessarily always a great fit. But sometimes you do, and in those markets, you work with those people.
Yeah, that was gold. The property management company is one of your biggest things for looking at a small market or any market, and for contractors.
In regards to looking for local resources, if once you make that decision to do investments in an outer market, one of the things that I learned and that I teach is that don't assume that people know how to do it. Don't assume that they're going to do it the right way. You have to take a heavier hand in managing that project when it's out of state than you think. And that's where most people screw up is they think, well, I can remote manage it. I'm smart. I'm competent. I know what I'm doing. But when you're not there, you lose touch. So scope of work, high attention to detail and managing to that scope, and probably making some trips to really lock it down, at least in the beginning. And if you're not willing to do that, you might want to rethink your whole concept of investing out of state if you're not willing to make some trips. Because, listen, it's hard enough to manage the project next door. Things can go wrong, things can go sideways, I don't care how much experience you have. Imagine how much riskier it is when you're hundreds of thousands of miles away. You really have to manage more stringently and with a lot more detail. Scope work is key, and I'll tell you, meeting people in person. I mean, listen, we can all interview people, but don't you find that you get a lot more out of it when you can see them and you can see their body language and you can see how they're reacting to what you're telling them? That's going to tell you a lot as to whether or not you want to move forward with them. So it may be worth that investment to get things started, especially if you're taking the big risk.
I just want to talk a little bit about that GC part because seems to be everybody's biggest concern, hardest thing to cover in the investment, whether it be commercial or multifamily or single family. But it's like anything else in life. It's developing that relationship with that GC. You got to remember that we're in a people business, and so lots of things come along with that. The GC can't control each and every single person if their dog dies or something crazy happens. So remember that there's always things that are going to happen in there. So you have to develop that relationship. Now you can choose to GC it yourself, which is also what a lot of you do, but then you're managing relationships with 10 different subs. Whereas the GC, you're managing that relationship with him. So build that relationship. A lot of you can't be heavy-handed or bossy with them and stuff because they just don't work that way. They're used to being a boss. So if you develop a relationship and you have expectations, you as the investor also expectations. So it's a give and take relationship that you guys got to That's how it works. And you may not like the first one you go to. You may not like me. It's all how you click with that individual. So, and everybody clicks a different way with different types of personality types. So, be willing to develop that relationship and be willing to use one, try it. Maybe you only use them on certain portions of it and manage the other part yourself and see how he works. Go look into the job. Talk to the other people that are using him as well. And just remember, nobody's perfect. Don't expect this of your GC. Don't expect it of your subs. Things happen. Life happens. So you just got to be ready to do that and be ready to do your part.
Next question.
I'm curious in everybody's feelings in terms of the best markets to invest in lists. So everybody knows that if a stock, everybody's saying this is a hot stock to invest in, they're probably past the point of it making any sense. So how do people feel about the list that say, oh, these are the best markets for investors right now? Because the fact that it's out there in the public doesn't mean that there's going to be that much more of a hype around that market. Is it still a good idea to get in, or is it something that's more just kind of it's past its prime?
For that, my thought is, if you find a hot market, a market that's out there and everybody wants to go, there's a good chance that it means it's over the hill already and everybody's been following there. I also think that if you just go in and look at all those hot markets and analyze them yourself, you'll find little numbers, little patterns that will show you if it's a market for you as well. And a lot of that is what will continue to happen with jobs after today, and what is the absorption rate and all these different metrics that you'll still look at and just say, these are hot, but does it fit my criteria?
There's this list, there's a website, it's called best-cities.org, and you can look at kind of like a timeline. It has like a spreadsheet or a graph, and it'll do from like 16, 17, 18, and it really highlights them. So kind of what we like to look at is stuff that's maybe not in the top 25, but things that are in the top 100 that have made a big jump from 16 to 17, and that may look to have another jump in 18, or well, we're in 18 now, so maybe going into 19. I'll start to get my feet wet, look at some sites, talk to brokers, see how the market's going. But that might be a good start, just to look at some either big cities or smaller cities, so they have a list on those, just so that you guys can have it.
I think a deal's a deal, whether it's in New York City. Guys, a deal's a deal, whether it's in New York City or San Francisco. If the numbers work and everything works, does it matter if it's on that list? If you do the numbers right and you do your due diligence right, it doesn't matter if it's on that list or not. Now, are there going to be more people, and is it harder to find those deals in Denver or in San Fran? Yeah. I mean, a building went up for $93 million today. Does that make sense? It makes sense to somebody, but it doesn't necessarily make sense to us. So a deal's a deal. I don't even look at that stuff. What's our hot market in Denver to flip it right now? Sunnyside and the Highlands and Sloan Lake, right? Everybody's missing those. We already missed Sloan Lake, right? I had somebody send me a property in Sloan Lake for $375 the other day that can flip for $600. I mean, they're still out there. So I think you look at deal because, Dan, if you start getting caught up in the press and USA Today and People and Today Show and all that stuff, you're going to get yourself stuck in a lot of minutia that's just going to take you away from it. Numbers are numbers, guys. And look at the numbers. And anybody who knows me, it's all about the numbers. And who cares where or what? If the numbers work, do the deal.
Next question. We've talked about contractors. We've talked about small markets.
I got a question on your approach to financing. Syndicators, what is your approach? Do you try and get the max loan amount you can get on it? Do you have a certain sweet spot, or what's your take?
All right, so we do try to put the max loan, but it doesn't mean it's the highest amount that the bank will let you have. it's the highest amount that our debt service coverage ratio will allow and our projections will allow, and then we work backwards from there, and we start looking at all of the risks that would be, and anything that bad could happen, and what is worst case scenario. So it starts by trying to get the highest leverage, and then you work backwards to make sure that the banks will often let you have 1.2 or 1.25 DSCR, which means if you're making $100,000 for your NOI, your net operating income, you're paying at anywhere from, let's just say, 80-ish thousand for your mortgage. For us, if our income was $100,000, we wouldn't want to pay 80 of it, 80% of it. We would want to pay a lot less, like 65% of what we were getting in cash flows to the mortgage. So that's how we start, is go as high as you can and then make sure that makes sense. And then you go to the threshold where you're mitigating risk. Who else has a response on that? All right, next question.
What should you look into for capital improvements? Or what other strategies do you guys have? What are some of the strategies you're doing with your guys' projects? Are they all long-term, 20-year holds, or what other creative stuff have you guys done?
Okay, so for our holds, they've been 5 years. 5 years. We have one that's 2 to 4 years right now, and then another one that will be, the other two are going to be 5 years. So almost everything's 5 years holds, and we don't bank on a refi, which is something that a lot of people bank on. It is, hey, we're going to refinance this in 2 years or 1 year. So we typically have a 5-year hold. We plan to exit, which means to sell at that 5th year. And at that point, we want to give a certain return to our passive investors. On the 2 to 4 year hold, it's its own unique property. They just put so it's a $23 million property. So let's start there, because when you hear that they just put $3 million into it, that might sound like a lot if you thought it was a $1 million property. All right, so they just redid the roofs. They just upgraded all of the units, and right now on that property, there's not much left. We will trade the lighting. We will switch the fixtures out. That's about the biggest part of that we need to do as work on the property. But the rents are drastically below market right now, and we got the property drastically below market value. So that one has a huge upside, and it should be a lot sooner amount of time. And I think it's important to go in a little bit more about the type of loan that this is, so it makes sense. So this is 454 units in Atlanta. The type of loan that we have it's called Bridge to HUD. Now that's one loan, and it starts with what's called a bridge loan, which is similar to a fix and flip loan. Okay, so they give you an interest only, just like fix and flip. They give you a certain amount of money based on the value of the property. They don't care so much about the borrower as much as they care about the property. They're going to be very, very safe. This bridge to HUD, they go loan to cost. So, raise your hand if you heard of loan to value. Okay, what's higher? Loan to purchase. So there's loan to value, loan to purchase, and loan to cost. They're all three different. So what would be a loan to purchase if the purchase price was $10 million? What would be the loan to purchase? Somebody? $8 million? Okay, so if you were going to do a loan to cost, what would it be? Higher or lower?
Lower.
Higher. Because it's the purchase price and all of the other costs that you need to come out of pocket to buy that. So they actually go higher. So this particular, we have it at such a low, below market. So it should be selling at 30 million. We have it at 23 million. So the main thing to note there is they're giving us 85% loan to cost. So 85% of everything it's going to cost us to get into that property, to rehab any parts of that property. I'll bring this over to you one second. But let me get through it. Okay, so 85% of all of the costs, that's the beginning start value. Then there is what's called, after 2 years of that bridge loan, after 2 years of the bridge loan, instead of having to start a new loan and pay closing costs again, it rolls in and it's now called a HUD loan. So a HUD is, there's Fannie Mae, there's Freddie Mac. HUD's a little bit different. So we'll actually be able to, if we go to past the 2 year mark, if we pass the two, so what we want to do, I'm not making promises, what we'd like to do is just sell it before it ever has to become HUD. But if it becomes HUD, then we're going to keep it for 2 more years. Because it starts with a 10% prepay penalty, then 9, then 8. And so based on all calculations and exit in 4 years, it would be a phenomenal deal for the investor, for the passive. But if we can get out at 2 years, we might be able to give super high returns in a very short amount of time. So it's 2 or 4 years, and those are the reasons behind it. 85% loan to cost, which is better than loan to purchase.
My question was just percentage of appraised value. How much will they lend? Not at ARV, but appraised value.
So HUD is unique. Actually, where is John? John's not in here. This would be a super good question for John. We could hold off until he gets back, but usually on HUD, they will go 85% of appraised value. But also, if what you do, this is interesting, so write this down. HUD will do this. If you prove your market strategy on just a couple of units, so if you take 10 units and prove that you can get the rents higher, they'll value the entire building like that.
Based on cash flow. Gross rental.
Based on the cash flow for those 10 units, not for the whole entire property. They'll actually go higher based on what they see that you're able to do. Does that make sense?
Like on a percentage relative to the whole, or will they just prorate it based on as a percentage of?
He's a good person to ask. All right, so we're talking about HUD loans, and you're perfect for this. Yeah. So the question you were asking was
percentage of appraised value.
How much do they lend on appraised value? So let's talk Fannie, Freddie, commercial, and HUD. Okay, sure.
HUD lending, if you have an acquisition, they can go up to 85% in most markets, and if you have what they consider their affordable, they can even go even higher in some markets. That's sort of the standard threshold for them. The process with the HUD could be where you have to do, when I do HUD products for myself or clients, we do bridge lending to get us there. So a lot of times in the acquisition, you don't have 9 months to go through the process, and in most cases it could be 9 months or longer, just depending on how quickly, to get the acquisition done. Yeah. So HUD is a process. I will say HUD is kind of like a acquired taste, if you will. You have to be really understand it, but it's a great product because if you really get into HUD and the benefits outweigh some of even the longer term Freddie and Fannie financing, because you can get 35 years fully amortized on those deals. So when you're sizing a deal, if you're a holding type guy and they're fully assumable at pennies to the dollars to have somebody who's selling it to assume that note. The problem is a lot of guys, when they get in there, it's really expensive. The cost to get into a HUD loan is really pricey. So your average, let's call it like $1 to maybe $7 million like a Freddie and Fannie deal. On average, your closing costs with the lender, including their legal fees, could be, let's say, between 15 and 18,000, maybe 20, just to be conservative. Where if you do a HUD sizing deal in that same threshold, you could be well over $100,000 in fees and costs. So it's for somebody who really understands the long-term hold, and they're really going to be looking at something that they're going to hold for 10 years or longer. because then you look at the benefit of a 35 fully amortized deal, and your cash flow, it probably between that 7th and 10th year, you're sort of catching up with that. But the benefits, there are benefits there, and then the leverage. You just can't get the leverage in depending on. And I'll flip the script to like the Freddie and Fannie executions, because you have 4 market tiers in the Freddie and the Fannie execution. You have your top markets, your standard markets, your small and very small markets. Okay, and each of those markets will determine loan to values. Like how much can I get leverage? I think when we all want to size our deals for a multifamily, we'd love to have an 80% loan to value, 30-year AM, and a 4.5% interest rate. Well, those are going to be held for your top markets.
And a 10-year term.
And a 10-year term. And in your top markets, you could start even getting even 20 and 30-year Fannie and Freddie executions where you could get fully amortized out even longer. I mean, your balloon, if you will, could be maybe even 20 and 30 in some of those executions. So with HUD, I think if you spend the time and you really want to do it, I can certainly get you connected with some investors that do that because there's some cool opportunities when getting into HUD. The guys that get into it don't go back. They buy a lot of their properties. And so HUD has 2 sides, just so you know. They have a market rate side, and they also have a affordable side. And the difference between those is about 60 basis points in interest rate. So if you have an affordable housing project, which is HUD was really created for that. They're more into the affordable arena. So they do have a market rate program, but when you get into that market rate, the rates go up a little higher, and sometimes the Freddie and Fannie execution is going to be a lot better in that area. So your top markets, 80% loan to value. Your standard markets, let's call it like a Colorado Springs, you're at like 75, and then you get into your 70% is in your small, and then your very smalls are 65. Now, all of those, whenever you do a Freddie and Fannie, those all could be plus or minus, depending on the strength of the sponsorship. If you have properties in there, all those loan to values and the terms all could be plus or minus based on the experience of what. As I always say, there's always exceptions to the rules, and they're willing to be open to that. But those are sort of the standard loan to value ranges in those areas that you can get. So best leverage.
The appraised value would be 85%.
The appraised value, right?
Not contract price, but appraised value would be 85%.
Yeah, because if there's another twofold. If you can't get your guys to hold on to the property, meaning they won't wait 9 months for the deal.
Where I was going.
If you
pays the holding cost.
Well, let me tell you this:
9 months.
If you get a bridge deal, right? Yeah. So we have lenders that we work with that do the bridge financing, which is pretty awesome. They have pretty good deals. So the bridge financing, here's the difference: it'll change when you go from a bridge to a HUD permanent one in that 9 months. It changes because now it's a refinance, not an acquisition. So their loan to value changes to 80% if you're trying to cash out. So the benefit of that is in 9 months is you go 12 months on your bridge, or 18 months, maybe even 24, just depending on what you're trying to your value at. And then you take it out at 80% of the HUD, and now you're getting more value. You're going to be able to take some cash out at 80%, where you might not get that with a Freddie and Fannie execution, like in the top market. You might get 80% with a Freddie and Fannie on the acquisition, but on a refinance, it's only at 75, where you'll be able to get to 80. So from that bridge financing into that deal, you can get up to 80%. If they do have some exceptions to that rule where you can get up to 85%, but they won't allow you to cash out. But the benefit of that 2 years of bridge is you might as well size up the deal that you have some value add in there, and then you can get maybe some dollars for a renovation with the bridge lender, and get your stabilization even better, or even your rents, whatever your value add point is, and increase that. So there's some benefits of that.
The closing costs sound prohibitive.
Not really when you
said $100,000 to close.
It's all numbers.
Well, here's
all numbers.
Yeah, exactly.
But when you put the numbers into it,
cost numbers.
Here's the cool part: they'll finance all that too. So that's another part.
So I'm sure they will.
So a lot of their costs you can finance into the
But there
deal.
goes your ROI, like stair steps down.
Well, when you put it at a 35-year AM and you look at the interest rates compared to like the Freddie and Fannie, they're almost. If you have a true affordable, I'm just going to use that as an example. You have an affordable HUD. I'm just as an example. I'm not saying this is today, but if it was 4% with a HUD on their affordable, most of your Fannie executions are going to be about 5%. So there's about a percent interest. And that's just as an example.
Talking note rate?
The note rate.
Okay.
So when you take that note rate into perspective, you add another 5 years to the amortization,
Sure.
that cost and your ROIs and things, that starts to change that number. So when you put that into perspective and the abilities to cash out with that longer term and after that bridge loan, the numbers, if you do it right and you have the knowledge to understand that, the breakdown actually benefits you. It just takes people, they get fearful because they don't know that yet. And so HUD is not for just something you're going your first time out. But if you do, or anybody does have those opportunities, I have investors and people that do have that experience that can partner with you and help you to take down your first HUD execution.
The only other thing that he didn't say is we talked about they can go to 65% or 70% or 80 or 85.